All right. Here we are. Spring.
Springtime.
Lots of things happening, busy times. And I guess before the tariffs were the big topic in the news, everybody was talking about the crazy amount of mortgages up for renewal. This was last year and this year.
That's right.
And so we thought, why not demystify the renewal process a little bit and provide you guys with some information?
And what a better time than now to demystify, because as I look outside, it is springtime and it is very cloudy and misty, and I'm sure it's the same in Victoria. So, perfect time for us to kind of wisp away those clouds and give you a little bit of clarity on what this renewal process looks like and the best way to navigate it.
You've landed on the Mortgage Life podcast, where we strive to bring you mortgage-related info that's easy to understand.
We have conversations with market experts to bring you timely updates, because there's one certainty in this industry: things change.
I'm Mindy Bodwin.
And I'm Pete Solomosi. Welcome to the Mortgage Life podcast.
So as we're sort of sitting here trying to think about like what's the best way to approach this to explain the different things you could do, we found that presenting numbers is always a good way of showing the differences. So we can provide a little bit of an explanation on each different scenario you can do on renewal, as well as show how that would impact a mortgage payment. So you can see the differences in the payments based on these different options at renewal. So pretty good little tool here.
That's right. So if for whatever reason the numbers start to go over your head, just take a pause and back it up, because this episode, it will have a lot of numbers in it, but there are a few key scenarios that we're trying to compare so that you can see why one might be better in terms of perhaps a rate, another might be better in terms of perhaps your monthly payment. There's various advantages to each scenario and things that can happen in each scenario. So have a listen, and if you need to, go back and have another listen, because there's a lot of real gems in here. But the real critical part is we're just going to compare apples to apples. So we're going to start off with the base scenario.
So the easiest thing you can do when your mortgage is up for renewal is when you get the call or email or letter in the mail from your existing lender offering you your renewal package. There might be a 5-year term to select, a 3-year term to select. The easiest thing you can do is say, this sounds great, and just sign the document and send it back in, and you're done.
It's so easy, and a lot of people think that is one of their only options when it comes to the renewal. However, it's not. But it absolutely is the easiest thing you can do, because it really doesn't require much. So let's kind of back this up and talk a little bit about the scenario that we are going to present. So let's say back in 2020, you got your mortgage and it was a $500,000 mortgage. For some of you, that may seem like it's a crazy high number. For others, that might seem about right. But it's a nice, easy number to work with, because it will show you what happens over time. So in 2020, rates, as you know, were ridiculously low. 1.79 is kind of the base scenario that we're going to go with. The original mortgage would have been amortized at 25 years. And if you were to have paid that mortgage over those 5 years to get to today in 2025, your monthly payment would have been $2,066.93. So just over $2,000 per month. At the end, so right now, your mortgage balance would be $416,983. So just over $400,000. So actually, you've done pretty well over that 5-year period. You've paid down nearly $100,000. Nearly a fifth of your mortgage has been paid down.
And so what people are finding, because back in 2020, we had that 1.79. So when they get this renewal document in the mail and they're looking at the new interest rates, which are not 1.79, they're not 2.7. They're not even 3.79. So we figured we would use sort of the best market rate and just assume that's the rate that this lender offered on renewal.
Right. So we're kind of time stamping this to early to mid April 2025. Current best rates, Mindy?
Around 3.99.
Right.
So what we did is we are assuming again that, Bob and Jen are just signing their renewal document. The lender has offered them the rate of 3.99. They have 5 years less in their amortization period because they've obviously just had a 5-year term. So they're renewing at a 20-year amortization. And so what does that payment look like?
Bada bing. Do you think, okay, maybe I'll just pause for one sec. Some people may think that because your rate has gone from 1.79 to 3.99, your payment is going to like more
Double.
than double, right? That's the natural thought. No, it does not. This is a long amortization, so we still have 20 years left to amortize. The monthly payment today at 3.99% is $2,517.45. So you're about $500 more per month than your original payment would have been 5 years ago.
So interesting. The interest rate has has more than doubled, but you've paid down your mortgage, so you're less of a mortgage, but the amortization period is shorter. So a shorter amortization does mean larger mortgage payments because you're calculating it to be paid off over a shorter period of time. So in this case, those factors equate to an almost $500 a month larger mortgage payment. So for some people, that's okay. But for others, it's a challenge, right? It's a cash flow challenge. So we'll talk about different options as we go through. But first of all, let's just look at the pros and cons in just signing this renewal document.
So some of the pros are that there's no application. This is easy peasy. Like basically one signature and you're done. The other pro is that there's no appraisal, so you don't have to pay any money for that. There's no legal fees. There's virtually no time invested. You don't really have to do anything other than choose a term to renew into and sign the document. But there can be some drawbacks.
Yeah. So, main drawback is you don't have any negotiating power. You are just signing what your lender sends to you. Um, there's no flexibility. You can't increase your mortgage amount to pay off debts. You can't change your amortization period to lower those payments. You can't negotiate the interest rate. Uh, no extra money, no credit card debts being paid off. It's just literally exactly how it was from one day to the next, different different interest rate.
That's right.
And of course, by signing the renewal document, typically there's not a mortgage broker involved. I know Pete and I, we do still like to help facilitate this. For example, if the renewal document makes the most sense for the client, we're happy to help facilitate that. But we are external to the process, so we aren't able to negotiate rates or some other set of circumstances that would be better for the client into their next renewal term.
So that kind of gives you the big bulk of the idea of just a straight renewal at maturity. Simple, easy, but a little less flexible.
So there's this great product. I know when I first became a mortgage broker and learned about this, because I didn't know about it as a home buyer, which is unfortunate, that allows you similar idea, but you can move from one lender to another lender called a switch. And the purpose of this is to get a better interest rate.
Right. So this is what we're going to call scenario 2. It is a switch. And like Mindy says, the lender is going to change, but virtually everything else about the mortgage stays the same. So your balance stays the same. The amortization remains the same, but we can, through a mortgage broker like ourselves, we can actually go and advocate for you and your mortgage to get possibly better terms.
Exactly. And so this is one of the main benefits of when your mortgage is up for renewal, picking up that phone, calling the mortgage broker, because if that renewal document being offered to you isn't advantageous and perhaps the mortgage broker does have a better product, most often it's going to be a better interest rate. So in this case, because I'm just actually submitted a switch application, I was able to get the clients the rate of 3.89, which isn't something that their lender was offering them. Their lender was offering them 3.99. So, same scenario, same mortgage amount that we were using in the previous example of 416,983, same 20-year amortization. This time the interest rate is 3.89, and so in this case the payment would be $2,495 a month.
So that is a slight bit better than a straight renewal. And what does it beat the renewal by? $22 per month, somewhere around there.
Yes. So savings, but it's not a dramatic savings, right? So again, this is that things for some people who maybe they've had a this is some sort of change in their life for that first 5 years, or they're super busy, or they're traveling in Thailand and they can't, whatever it is, and the renewal is just the easy thing, that's fine. But in other cases, we can advocate and get the lower rate. So, but back to this potential for an application. So, what is required to do the switch?
Good question. So, in terms of a switch, it's basically like a new mortgage application. So, we would collect income documents to verify your income. We would also collect any other property documents, and that would include things like your current mortgage statement and property taxes. Lastly, an appraisal may be required, but I find that typically when it comes to switches, especially in our increasing property value environment, sometimes the appraisal can be waived. So that might be required, but on the bright side, a lot of times the appraisal is covered by the lender, or there are built in kind of methods that the lender will chip in for a lot of these things, either through a rebate or through paying for it.
That's correct. And same with the legal aspect. This is quite often not handled by your traditional conveyancer. It's usually a closing service, First Canadian Title. And typically the lender does cover those costs. So they want your mortgage. So they're going to try to make it as easy as they can on you, as are we, the mortgage brokers. So, what does this mean for your mortgage? I mean, it's essentially the same as signing the renewal document. One main difference here, though, is you can add up to $3,000 of any costs that occur as part of this switch. So, some cases, the previous lender will add on an admin fee, or you can do a midterm switch, not to get too complicated, but in that case, there could be a penalty. So you could add up to 3,000 of that onto the new mortgage amount. So you can slightly increase the mortgage. Other than that, it's basically the same as the renewal.
Well,
It's pretty
and the beauty
samesies.
is that your broker is going to advocate for you. So, like Mindy said, we've advocated for this particular client, and we've gotten a rate that is 0.1% better. That translated to about a $20 per month savings, which is a little bit of a savings. But
Mhm.
the real benefit is if you look at that over the term of the next 5 years compared to just a straight renewal, that's about a 2,000. It's just over a $2,000 interest savings. So
Mhm.
when you think about the little bit of work that you put in, it actually adds up. So 0.1% isn't just a tiny little bit; it is $2,000, which in today's environment with groceries being expensive, $2,000 means a lot.
Yeah, absolutely. I mean, that's part of a vacation to Mexico.
Exactly. Exactly. So in terms of benefits, yeah, we're going to get you a phenomenal best market rate. It's typically, this used to be known as a no cost. I like to call it a low cost option. There's very little or no, it's very minimal fees involved in doing this. A little bit of time invested on your part. And in terms of drawbacks, it's the time part. It's the
Mm.
document collection, signing. If there is an appraisal required, that just means allowing access to your property. And so that's kind of it. And in terms of your other debts, again, those aren't encompassed in this type of product. You'll still have any sort of unsecured debts still in place. There's no real new extra money involved in this mortgage. Mhm.
Which brings us to our third scenario. And I would say this scenario emerged within the past couple of years when we saw the low rates being renewed into the higher than they are now rates. Like January last year, I remember I had to do a renewal at 6.02%.
Yes.
So in that case, there were a few examples where the renewal paperwork provided by the lender had a payment that just was not feasible for the client. And so we kind of had to rejig because even the switch, we couldn't quite get it to work. And so this new option came up and it's helped out quite a few clients.
Right. And so we're going to call this third option a re-amortization. So we're going to push out the amortization. This can also be thought of as a cash flow solution. So it's a way to decrease your monthly cash outlay, or at least to mitigate and manage it to the point where it's very similar to what you may have had in that extremely low rate environment. So Mindy, what do we need to do for a re-amortization?
So, first of all, let's just show how effective this can be. So,
That's
again, we'll
probably
go
a good
back
idea.
to the same balance for 16,983. The interest rate is a little bit higher here because it may or may not be a previously insured file. Anyways, don't need to go down that rabbit hole, but we're just using a slightly higher rate at 4.04. And also to show you how effective a reamortization is. This time we're extending the amortization out back to the original AM of 25 years. So we're going from renewal AM of 20 up to 25.
Gotcha.
And in this case, the payment would be $2,200 a month, which is crazy, right? Higher rate than what you're being offered by the renewal lender. The renewal lender is offering you $399 at 20 years, which is a $2,500 payment, and we can re-amortize 4.04 for a $2,200 payment.
Right. And that $300 per month, that for some people can be the difference between being able to live comfortably and not being able to pay bills. And oftentimes we find that this is a really viable solution where you're still retaining your home, you're still retaining your equity. We're just giving you a little bit longer time to pay off the mortgage, decreasing that monthly cash flow so that you've got more to spend on the other things in your life.
Absolutely, and it's such a good lesson, I think, for clients as well, because we are also rate focused. We're rate focused on our mortgage rate. We're rate focused on our rate of return on our investments. But like this shows you very clearly that sometimes rate isn't everything. Even though we tell you this is a concrete example of that.
That's right. That's right. So I jumped the gun a little bit with talking about what's required, but let's get into that now. So we know that we're going to save a little bit of money. What do we need to do?
So in this case, to do it as low cost as we can, there is this other little loophole where if your existing mortgage, the one that's up for renewal, is a collateral charge or running account, just a different way of registering a mortgage, we can do this as a switch, basically the same product that we were talking about before. But because it's that collateral charge, the new lender will be able to bump the amortization back out to 25 years. So that's the main requirement. And then again, just like the switch we just discussed, there would be the mortgage application, income verification, document collection, appraisal may be required, new legal registration of mortgage. So, same thing, there is the mortgage application, but again, like you can see the savings here.
And in terms of options for you, when we do this kind of a switch on a collateral, oh, and I should say, just really briefly, that a collateral charge, if you're curious if you have a collateral charge, you can ask Mindy or I, or it's kind of one of the kind of tells in terms of a collateral charge tends to be that if you have a mortgage with one of the big five banks, most, but not all, are registered as collateral charges, and most, but not all, credit unions are registered as collateral charges. It really depends. So the best way to find out is to contact your mortgage broker, talk to Mindy, talk to myself. We are actually able to pull the title and figure out exactly what was done on that prior mortgage.
Yep. Yeah, so what does it mean for your mortgage? So, similar to the past two examples we discussed, your mortgage balance stays the same. As with a switch, you can add up to $3,000 of the admin costs. Term can be 1, 2, 3, 4, 5 years. Interest rate is the best when your mortgage broker can find you in the market. The big difference here, of course, is that you can extend that AM back out. So 20-year remaining can go back out to 25, or say your original AM was 30, you could even go back out to 30. So pretty
That's
cool.
right. That's right. And in terms of costs, this is very similar to scenario two, where typically we call this kind of a low cost, no cost option. The lender typically covers the cost of the switch, including potentially the legal and appraisals. Again, it's not like your typical mortgage where you'd actually connect with a lawyer. There's kind of an internal legal system that takes care of that registration. And again, as in the previous example, there could be potentially admin fees from the prior lender. Again, a lot of those can be kind of uh, almost bundled into the existing mortgage at a maximum of $3,000.
Biggest benefit here, I think I've said this a few times, the significant reduction in the monthly payment compared to a straight renewal or even a switch for a slightly lower rate. So in our example, that almost $300 in monthly savings, definitely this is something to consider for clients up for renewal that have that sticker shock when they see the new payment amount. So it frees up monthly cash flow, and it's typically low cost, no cost, and it's near best rate. So win-win if you ask me.
Exactly. And as with the previous scenario, very much like the last time, we have a little bit of an investment in time from you. So we're going to be required to collect documents, sign, potentially allow for an appraisal access. No new money is really advanced, just the small admin fee side of things. But really, that's it. It's a fairly low cost option for a big monthly win.
So I have a question. The only way that you can do that is if you have a collateral charge mortgage. So what happens if you don't have one of those? What do you do?
That's a good question. So if you don't have a collateral charge mortgage, the next scenario that we have is called a refinance. It essentially involves paying out the existing mortgage. And I should say that when you pay out an existing mortgage at maturity, so that's the 1 day, it's the maturity date, it's 1 day, there is really only one cost to doing that, which is the discharge fee from the existing lender. So it's $75. There's no actual penalty to pay out a mortgage on the maturity date. So when it comes to a refinance, it's not like there's going to be a penalty to do this refinance, but we have the ability to do a bunch of things on a refinance. So let's simply talk about taking this existing mortgage of 416,000 and change and refinancing it. Mindy, tell us the numbers. What are we going to do
So
here?
this is so exciting that it's shocking, really, when you look at it. So same mortgage amount, 416,983. Now we're talking about a higher rate. This rate is 4.34%. Okay, so not the 3.99 that your bank offered you, 4.34, because in this case these clients, they want to get back down to as near as they can to that original payment. So we're re-amortizing out to 30 years. And so the 4.34 is the best market rate for a 30-year amortization. And the payments become $2,063,
Wow.
which, if you go back to the original scenario, 5 years ago at 1.79%, your payment was 2066. So you're actually
Right.
$3 less.
Oh my gosh.
Crazy.
So this is a really, really fantastic scenario for someone that is absolutely concerned about that monthly cash flow. And in terms of rate, we're not that far off. The rates are pretty close. And there's a very, very long explanation for why the rates are a little bit higher on a refinance. But suffice to say that despite all that, your mortgage is still the same balance today because you've paid it down. you just have another option, which is this refinance option, which gives you the ability to go out a little bit longer and have that little bit more of a comfortable payment.
And so, what's required? So, just like in the switch or the collateral, past couple examples, we would need a full mortgage application, income verification, document collection. A little bit different than a switch or that collateral switch is appraisal is most likely required in this case. The lender wants to make sure that they have that equity position. And in this case, the new lender's most likely not going to want to pay for that appraisal. Some lenders do have an appraisal rebate program, would be like a nominal amount that goes towards the cost of the appraisal, but this would be a cost that would be borne, an upfront cost. And same with the legal. So this wouldn't be facilitated by an internal solicitor by the lender. This would be you getting your own lawyer or notary, um, getting the legwork, getting the quotes. I mean, sometimes we can do that for you, but still there's this sort of extra bit involved, and that would be an upfront out of pocket expense in order to get this much lower payment.
Right. And so what this means for your mortgage is in this scenario, we've left the balance the same, but we've been able to go a little bit longer in terms of that amortization. We have the options again of doing 1, 2, 3, 4, or 5 year term. We can go fixed or variable. It basically means that you have access to an entire suite of lending opportunities. Like Mindy said earlier, and like I said, the interest rate does tend to be a little bit higher because these mortgages, they're considered to be the bank's kind of least desirable mortgages. Just to kind of give it a really short, quick explanation,
Higher
they,
risk.
higher risk. Yeah, it's not that your mortgage it's higher risk. It's just that from their product
Yeah.
perspective, that's what they see. But again, what does it mean for you? It means that you get a ton of flexibility. So, what are the costs, Mindy?
Again, appraisal, 98% probability it will be required. That's coming out of your pocket. Legal fees, that's coming out of your pocket. Title insurance, that's coming out of your pocket. We will sort of touch on another scenario where there is a way that that doesn't need to come out of your pocket, because on a refinance, you really are starting from ground zero, clean
Mm-hmm.
slate. So you can adjust the mortgage amount. But for now, we're just kind of keeping apples to apples here. So
So, stay
those,
tuned.
yeah, those would be costs.
So, benefit wise, what do we have for benefits, Mindy? Rave. Give me some raves.
Yeah, significant reduction in monthly payment compared to all of the other scenarios. In this example, if you wanted to be a little bit patient and call your broker, you would be saving almost $500 a month if you don't just re-sign that renewal document.
That's
It's
huge.
really, I mean, the numbers speak for themselves. This $500 a month saving obviously frees up monthly income for cash flow purposes or for saving. You know, don't know about putting it to the stock market right now, but I'm sure there's other things you could be saving. But and then, of course, we can kind of move into, the next scenario, which again, refinance, so could be used to pay out other debts as well. But what
Exactly.
are the drawbacks?
Drawbacks. So, very similar to the other three scenarios that we've talked about, we are going to collect documents, except for the first one. We are going to collect more documents. Again, income documents, property documents, potentially appraisal, access to appraisal. So, there's the time involved in all that. Um, the fact that we've re-amortized the mortgage to a longer period means that it does take longer to pay off your mortgage. I am going to say one small thing about that. It frees up cash flow immediately today. And take note that most mortgages allow you to increase your payment. So even though we've lengthened the amortization out to 30 years, this doesn't mean that you can't set your amortization lower by making increased payments. And especially if you choose one of the following. Number one, use an accelerated payment. So that's a biweekly accelerated payment or a weekly accelerated payment. It essentially allows for one additional full payment per year. That typically drops your amortization by about 3 years. Or by just making a scheduled, regular, lump sum payment. So that could be an additional 100 per payment or whatever number you choose. Those things can all help mitigate that lengthened amortization. So I know I was talking about drawbacks, but I had to throw in the benefit in there too. And the fact that there are some upfront costs, that is one of the other things to consider on that. And I know, Mindy, when we were talking about upfront costs, that you said there is a way to not have to pay those out of pocket. So give us scenario 5.
Right. So scenario 5, we're stepping away from our 416,983. Okay. So this is your mortgage is up for renewal. We're doing this on the maturity date, like Pete described. So there's no penalty. We are starting clean slate. We are doing a full refinance. We're doing a new mortgage amount. We're doing a new amortization term, interest rate. And the great thing about this is that we, as you've seen, we get that monthly cash flow savings by doing the amortization extension. And we're also using some of that extra mortgage money to pay out your unsecured debts, meaning, your high interest credit cards or I've had some people pay out vehicle loans on a refinance, right? Because vehicle loan rates got high there as well.
Yep.
And it's a double whammy, a double monthly cash flow boost, lower mortgage payment, and you don't have those debts.
That's right. So just to give you guys a sense, a regular typical consumer credit card is anywhere from 10% to 24%. Regular typical auto loan. So in the last little bit, Mindy talked about how the auto loans actually went quite high. Those were anywhere from 4 to 12%, depending on if it was a new or used car. Most typical lines of credit are usually somewhere around prime plus 2. So that would be about 7%. To I've seen them as high as prime plus 7. So now we're looking at about 12%. So any one of those numbers, any one of those other debts that you have are way higher than what you'd be paying on the mortgage. And I know what you're thinking. You're saying, well, I'm going to take one of my debts and just throw it into another debt. Well, why does that make any sense? Well, it can make sense based on two things. So Mindy talked about that monthly cash flow. By wrapping that in, you're decreasing your monthly cash flow. So for instance, if you've got a credit card, you have to pay at least 3% of the balance of the credit card. So that 3% of the balance can be a quite high number. If you have a $10,000 credit card, that's $300 per month. That is a typically a much higher number than if you had a $10,000 amount on your mortgage. That would be a much lower amount per month. So to give you a sense, on a mortgage, that would be about $50 per month. So
And
it
the
is a
reason for that is because, again, that mortgage is amortized, calculated to be paid off over that 25 or 30-year period, as opposed to the credit card, which is right now.
exactly. But the one thing I did want to say in how this all works in your favor is that if you bundle everything into one debt that has a much lower rate, so this is going to be a much lower rate than any of those other unsecured debts. If you choose to make the same payments that you were making before, not only can you pay off all these debts a lot faster, but your mortgage broker, so Mindy or I, we can tell you exactly how much you'd knock off. I actually have a great client right now who this is the exact scenario that we're working on. We have a number of unsecured debts that are being bundled into a refinance. And if we just purely look at the amount that they'd be paying monthly, it would show a 25-year amortization. But if we take every one of their payments that they currently pay monthly and make that the monthly payment. So in effect, we're taking the current mortgage payment, but then adding all the other things to it. It actually knocks the amortization down to 15 years, 3 months. So by paying the exact same, your cash flow is the exact same, your mortgage now gets paid off in 15 years and 3 months. So
That's
it
incredible.
it does work.
Yeah, it's just incredible. It's, for so long there was such that, I mean, bless the media, but it's just, sort of the tone, right? The, oh no, my mortgage is up for renewal. But it's actually an opportunity. It's an opportunity to make change that works better for you. Renewals in 2025 aren't nearly as daunting as they were made out to be.
Right. And I think, Mindy, I think we have hopefully helped demystify the whole renewal process.
Mhm.
And hopefully your spring becomes a little less misty because of it.
Work for me. The sun's shining now.
If you have any questions, as always, please feel free to contact us. We're always happy to run through scenarios and show you what kind of options you might have.
This is The Mortgage Life.
We look forward to continuing the conversation.
So come back and listen.